Today on Inside the Issues, I speak with Pierre Siklos on debt and the global financial system. Hello and welcome to this week's edition of Inside the Issues, a CIGI online podcast. I'm David Welch, the Balsillie School of International Affairs CIGI Chair of Global Security and Professor of Political Science at the University of Waterloo. And every week I'm very pleased to welcome a guest into the studios here at the Centre for International Governance Innovation in Waterloo, Ontario, to speak about some timely and important topic concerning global governance or international public policy. And today I'm very pleased to welcome my colleague Pierre Siklos, who is Professor of Economics at Wilfrid Laurier University and also the Director of the Viessmann European Research Center, as well as a Senior Fellow here at CIGI. So welcome, Pierre.
Thank you.
Your specialty is the global financial system, and you've been paying particularly close attention to the current global debt crisis.
Right.
And for our audience and for me, in other words, those of us who aren't necessarily technically expert in this area, could we start with a little bit of background? What's the nature and the causes of this particular global economic crisis, and how does it differ from previous global economic crises that we've seen?
Well, I suppose you can go back to the 1990s, early 2000s, when you had the first bout of sort of low interest rates, when central banks, which by that time in the industrial world got used to using interest rates as the primary instrument of monetary policy. And there was fear of deflation at that time. And so that drove interest rates down. And as a result, of course, it made borrowing more attractive. But initially, the borrowings were attractive for the private sector, but eventually became attractive to the public sector. Interest rates went up a bit again in the early 2000s, after the sort of the tech bubble in the early 2000s. But it didn't go up very much, and some thought they went up too slowly, and it didn't seem to stop sort of the debt from accumulating. And eventually, interest rates went down again because there was a fear of, there was the global financial crisis, whose origins probably started with bad choices made in the private sector about financial instruments and how they should be structured, combined with probably some poor supervision and regulation, basically complacency all around. And that helped fuel the current problem. And then, of course, Europe comes into play, but for different reasons. There, it just happens that 2 or 3 years after the global financial crisis, the flaws in the original setup of the Eurozone came home to roost in the form of, again, debt crises in the smaller countries like Greece, Ireland, and Portugal. And that's where we are now.
So I'm interested in talking about the particular circumstances of Europe in a minute, because that's where we've had the outbreak of the real disease here. But just to back up a bit, so almost all countries run debt, sovereign debt. They borrow against, I suppose, future economic growth, right? And what are the guidelines or rules of thumb? In other words, what do economists look at to try to decide whether a government is borrowing too much?
Well, we call it the simple monetarist arithmetic. Basically, we look at what's the real cost of carrying the debt. And essentially, it's what you pay on the debt, so the interest rate you see on long-term government bonds, for example. And these are typically sort of bonds that mature in 10 years or so. You roughly subtract from that the current rate of inflation, or some average inflation rate, and that gives you the real cost of carrying the debt. And the simple rule is if that real cost is higher than the economic growth rate, debt will continue to build up and will become unsustainable.
So it's a rate measure rather than a ratio measure. I mean, the rule of thumb for households, as I understand it, is if your household debt is twice your annual income, you're in trouble.
Right.
And if it's roughly the same as your annual income, you're probably okay.
There's probably a similar rule for governments, but typically we stop at sort of looking at the real cost of debt versus economic growth.
I see. So why in Europe? Why have we seen this problem all of a sudden become acute in Europe? I mean, it was also acute in the United States recently.
Right.
They had a major domestic debt problem, and of course they recently had trouble getting their debt ceiling lifted in Washington, reluctance on the part of Republicans to do that. But the United States managed to sort of keep that more or less within its own boundaries, and the Europeans haven't. Why is that?
Well, Europe is, at least in my opinion, is sort of a failure of the market as well as governments. When the Eurozone was created, at least in the years before the Eurozone, those who sort of thought up the system or constructed the system basically agreed that there should be convergence requirements. And essentially what that means is they wanted to make these economies at the macro level as similar as possible in terms of inflation rate, debt rate levels, interest rates, and so on. And in addition, of course, they passed all sorts of regulations to make sure that you could do business in different parts of the European Union, and the standards would be similar. So broadly speaking, they wanted these economies to look more similar. And once these economies passed the test, then the idea was that they would join the common currency. And so back in 2001, when the euro was introduced, this was after a few years when at that time there was 10 or 11 countries that sort of met these convergence requirements. And so people thought, that's it. These economies are similar enough. They'll behave the same way. They're different, of course, but they're similar enough that the common currency will work. But then the market sort of looked at the situation and felt that the debt, the cost of carrying the debt should be much lower in some of the periphery countries. So interest rates, which historically were high in places like Greece, for example, or Portugal, began to fall to levels that were not that much higher than in Germany.
As a result of policy choices?
Well, I guess markets were gambling. They were saying maybe either these countries were similar enough to Germany that they could be trusted, or basically they took a gamble that if things went wrong, they'll be bailed out. And so governments saw this as an opportunity to borrow much more than they could, because all of a sudden they got this implicit subsidy. They could borrow at, let's say, I'm just giving you an example, half the rate they could before the common currency came into being. Now governments then stepped in and failed because they saw this happening. They were equally puzzled by these low rates, but they let the debt build up in these countries like Ireland. Well, Ireland is a special case. We can talk about that because the banking sector comes into play. But Greece, for example, governments began to borrow, and Portugal to some extent as well. And then, as it often happens with these crises, markets wake up someday and they decide this system is no longer sustainable, and we have the situation.
And these markets are private investors and large institutional investors. They're not other states.
And they're not just in the European Union, they're all over the world.
All over the world.
They all hold this debt.
All right, well, we'll continue with that in just a moment. You're watching or listening to Inside the Issues, a CIGI Online podcast. Look for us at cgionline.org, on Facebook, on Twitter, and on YouTube. Welcome back. So just continuing with this exploration of the European situation. In Canada, we have provinces that have very different economic profiles and different levels of economic performance. Some boom in some year and bust in another, and vice versa. We have a common currency. It works, and we don't seem to have these problems that Europe as a whole and the Eurozone is experiencing. So what's the difference here? Why is it that Canada is able to manage these macroeconomic imbalances at home, and Europe and the Eurozone can't manage it among themselves?
Well, I suppose one thing is luck. We are, after all, a resource-based economy, so we have commodities to sell. And we happen to sell these commodities at a time when there was a demand, a boom from Asia in particular, in general, but China in particular. Second, we had our own sort of near fiscal crisis back in the 80s, and famously, you probably recall perhaps the Wall Street Journal thinking of us as basically a third world country, because we were hitting near the debt wall. And so there were changes in regulation, improvements in supervision, and the fiscal situation, at least at the federal level, improved considerably. And provinces could not count on the federal government to bail them out. There's no implicit or explicit guarantee that if there's a debt problem at the provincial level, that the federal government would bail them out. And so provinces, when they borrowed, especially when they start to borrow abroad, they faced the international markets, and they had to pay a premium for these loans. And they came to the same realization as the federal government, which is that if they keep on the same route, it's not sustainable. So they got their fiscal house in order. And lastly, what helped was strong growth at the time in the world economy. So that made it much easier, much less painful or costly for provinces and federal government to get their fiscal house in order to introduce the legislation that would protect consumers and markets from excesses in the financial sector.
Now, when people set up the Eurozone, did they not anticipate that there would be these kinds of potential crises down the road, that there would be significant differences in the economic performance of different countries in the zone? Some of them might borrow beyond their means. Did they think about how they would deal with that? There's no equilibration mechanism. There was no formal transfer mechanism in the Eurozone, so there was no sort of automatic reallocation of resources in order to help distressed economies.
Well, the answer is yes, they did think about it. In fact, just one of the architects of EMU, European Monetary Union, Jacques Delors, said that if you read the report that led to the eventual creation of the Eurozone, there were clauses or paragraphs inserted that emphasize the importance of surveillance, that you can't let the system just run amok. Once you start this common currency, you need some control mechanisms. Now, for a variety of political reasons, they didn't want a transfer system. There are already some implicit transfer systems in the European Union. There's this common agricultural policy, which was viewed as being one type of transfer system. And they didn't want a sort of a supranational welfare state. So what the Germans insisted on the eve of EMU was the introduction of the Stability and Growth Pact. But it didn't have the same force, at least in law, as the Maastricht Treaty, which created the euro in the first place. But it was an agreement that if there was excessive deficits, that there would be penalties. But the odd thing was, or two odd things. First is that you basically made the fiscal situation worse if you violated the Stability and Growth Pact. So that didn't make it terribly credible. And then in the early years of the stability of EMU, both Germany and France began to sort of water down the Stability and Growth Pact. They excluded certain things, ignored others. The Germans in particular were going through their reunification period after the fall of East Germany, and this created huge costs for them. And so they basically took a pass on the Stability and Growth Pact because they found ways around it. And so the whole credibility of that alternative mechanism that was to prevent excessive debt was never credible in the first place.
Now, in the old days before the euro, if a country such as Greece got into trouble of this kind, investors would still punish them by demanding higher and higher rates of return on their bonds.
That's right.
There'd still be pressure on the government to get its fiscal house in order, but they had their own currency, right? So that's an important difference now. How does that difference play out in the current crisis?
Well, as you point out, the exchange rate was the mechanism where countries could adjust. And so that would mean your country's currency would depreciate, there would be inflation, hopefully temporarily, that would deflate the debt, because debt is in nominal terms, and so in real terms it would be less costly. And then they would hopefully use the time to restructure their economy to become competitive. In the case of the euro area, you don't have that option. So you need someone, if not the central bank, someone to help bail you out. So the only other thing that can be deflated are wages and costs. And so all of a sudden you have countries like Greece where wages and prices would rise very quickly towards sort of Eurozone type or German type levels. And now all of a sudden their wages and prices have to fall quite substantially. And historically those have proven very costly economically.
And how fair are the criticisms, especially from Northern Europe, that Greece is only reaping as it sowed? That they have a different lifestyle there, different working hours, different norms around provision of public goods, and it's just not disciplined the way it is up in Northern Europe, and so either they have to be more like us or they should rethink their membership in this enterprise. How fair are those kinds of criticisms?
Well, it's a pretty touchy subject. It's sort of a little bit outside of economics, but I suppose in blunt terms the answer is that's correct. However, there were rules in place to make these economies as similar as possible to the ones in the north. And in principle, Greece passed these tests. We now, of course, know years later that the Greeks fiddled with their national accounts. So they actually didn't pass the tests. But then the rest of the Eurozone members and the EU more generally basically said, okay, we'll turn a blind eye to that.
They weren't the only country to do that, were they?
Well, they're the most noticeable case. Italy supposedly did some of that, but it was less, let's say, less outrageous, less clear than the Greek case. The Greek is a typical example of where they really fiddled the numbers because for political reasons, they desperately wanted to be in the Eurozone. there was reluctance to let them in. They were allowed in a little bit later, just basically a year later than the rest, as a show of solidarity. And there was sort of an implicit promise that, well, now that they're in, the return to the rest of Europe is that you'll become more like us. And the Greeks basically didn't follow through on that aspect. So
imagine there was a certain amount of thinking that Greece is a relatively small economy, and so we can afford to let one in that's not necessarily as disciplined.
That's right, yeah.
We'll be back again in a moment with Pierre Siklos to talk about debt and the global financial system. You're watching or listening to Inside the Issues, a CIGI Online podcast. Look for us at cgionline.org, on Facebook, on Twitter, and on YouTube. Welcome back. Let's talk a bit about the contagion effect here. So we've had this acute problem in Greece, which we've all been following closely for a while, and follow-on problems, concerns with Italy, the next country that looks like it's in real trouble. And of course, larger concerns that this will reverberate around the globe and cause a global financial crisis. Some clear indications, according to some, that that's already started to happen. So why is this happening now, and what mechanisms are in place in the global financial system to try to contain these kinds of spillover or contagion effects?
Well, it's happening now because of sort of this buildup of debt. First, you had Greece, you had Ireland, you had Portugal. So you didn't have just one country. You have now 3 countries in the Eurozone. It worries them in Spain. Now, Spain didn't have the same debt problems as the others, but it has very high unemployment. It had structural issues. Italy had also structural problems. For example, its economy is heavily regulated in certain areas. Now, Italy, unlike Greece, has a large manufacturing industry, so the worry is not the potential for growth, but the worry are the regulations that prevent growth. To some extent, in the case of Spain, you had very high housing prices driven by other people in the Eurozone buying property in Spain, and the housing boom collapsed. Their banks were protected, at least the large banks, but the regional banks weren't because they weren't as well regulated. And so once investors start to doubt one country in one area, they start to doubt the fiscal responsibility of other countries. And then you have the banking system. The banking system is one of the most sort of globalized sets of institutions. And markets and investors began to find out that banks all over the world were holding debt directly or indirectly in these Eurozone countries and elsewhere. And so it doesn't take long for the message to spread, and so doubts are raised in banks all over the world, not just in the Eurozone.
So as a professional academic economist, let me ask you this one. Is it fair to say that there's roughly 2 schools of thought in economics? And one is that markets basically operate according to classical standard rational cost-benefit mechanisms. And the other is that markets are basically group psychology, right? There's a herd mentality, and that investors behave not necessarily for good quality cost-benefit reasons, but as you mentioned, by imagining that if it's happening in this country, it's obviously going to be happening in some other country, even if that country might have quite different economic circumstances. Is that second school of thought being vindicated now? Are we beginning to rethink our basic understanding of these markets? And are we beginning to pay more attention to the psychological dynamics of how these large-scale things work?
There's no question that the psychological element has become far more important. I don't think economists are quite yet ready, sort of for the most part, to abandon rationality. But they'll say that, in calm times and normal times, we're rational. And every so often, things happen, either because the supervision is poor, or regulation is inadequate, or someone or some government misbehaves for whatever political reasons. Then things go off kilter, and then psychology starts to take root. And then you potentially have these contagion type effects, and contagion is an example of irrational behavior because if you look at, say, let's take the example again of Spain versus Greece. Spain's macro fundamentals, for the most part, look all right compared to Greece's, and yet Spain and Greece are lumped together. Similarly with Italy. The fiscal situation in Italy is not as bad, nearly as bad as in Greece, but they're sort of all painted with the same brush. So fundamentals begin to matter less, and then sort of rationality then goes out the door. And so we worry about, at least at the macro level, we call it contagion. at the financial sector level, we call it herding type behavior. So I think those issues are becoming far more important in economics. But we're having a little bit of a tough time modeling these things because it's not so straightforward to move away from the rational world, which is mathematically very easy to deal with. But in the less than rational world, it becomes a lot more complicated.
That's right, hard to find equations that actually map onto psychological behavior.
Right. But it's more interesting.
It's interesting indeed, yeah. Now you mentioned Ireland. Now Ireland, as you say, is also in a difficult situation now, but it also had a very acute crisis a few years back. I forget exactly which year it was. Yeah. You mentioned that the banking sector was involved.
Yes.
Are there any lessons to learn from the earlier Irish crisis that would be helpful in this one?
I think there are. Ireland is a different case from Greece because Ireland did not have a fiscal problem. It was a very fast-growing economy. In fact, it had surpluses. But when the banking system entered a crisis period, they were clearly in large insolvencies. The government, instead of turning to the rest, say, of the EU and say, look, we need to deal with this, either we deal with this jointly, or we allow the banks to fail, or there's some kind of resolution process. The government at the time decided to bail out the banks. And so all of a sudden, literally from one day to the next, the government sort of had this huge debt burden, way beyond its GDP, 200 or 300% of GDP. And clearly, markets saw this. And even if the banks were bailed out, you had a system where the banking system was about to collapse. Now you have a system where the fiscal house is completely about to collapse. So the lesson is, if you're going to do some kind of, if your banking system is in crisis, perhaps don't take the debt that's accumulated in the private sector and just lump it into the public sector. The people who made the bad decisions should be accountable to some extent. There's going to have to be some kind of public support, but not to the same degree as they did in Ireland. It was just massive.
And in Greece and Italy, it's not that banks are in trouble.
No.
It's that governments are in trouble.
No, in fact, many of the Greek banks were very healthy. They didn't even own or have very much Greek debt on their books. But in part thanks to the way the Eurozone works, and in part because of the ECB, they were sort of, maybe forced is a strong word, but they were encouraged to hold more of Greek debt. And so now, all of a sudden, not only the Greek government is in trouble, now the Greek banks are in trouble, and indirectly banks elsewhere in the Eurozone. So, when we think of Germany as being a good example of fiscal responsible government, that may be true, but their banking system is deeply involved in this bad debt. So part of the reaction of the Germans is due to the weaknesses of their banking system.
It's ironic. It's privatizing risk, isn't it, instead of socializing
That's right.
risk.
That's right.
We'll be back once more with Pierre Siklos in just a minute. You're watching or listening to Inside the Issues, a CIGI Online podcast. Look for us at cgionline.org, on Facebook, on Twitter, and on YouTube. Welcome back. So Pierre, let's talk about us for a minute. Canada. Was Canada lucky or smart in escaping this acute crisis that we're witnessing in Europe at the moment?
Well, I guess a little bit of both. I suppose we were smart because we did get our fiscal house in order, and to some extent sort of our regulatory house in order at the right time. By that I mean on the eve of a very strong growth spurt, not only in the US, but in the world economy. So to that extent, it was luck because we don't choose the timing of growth cycles outside of Canada. But having done so, we stuck with the program. We remained fiscally responsible as the economy was growing. And so we were smart because we allowed ourselves to, both at the provincial and the federal level, to have a tremendous reduction in the debt to GDP ratio, which was approaching 100%, down at least at the federal level to under 40% in less than a decade. And so if there was a big shock to hit the Canadian economy, at least we had some room to maneuver. And the quality of our debt was viewed as being the highest. And so that meant that if we needed to borrow, we could borrow at a lower rate than other countries or other jurisdictions. So in that sense, we were smart.
And how much credit does our healthy banking system get for our relatively good performance at the moment? We trumpet it, right, as a model of sound regulation and healthy banking practice. Is that fair? Is it important? Is it part of the reason why we're escaping some of this at the moment?
I think it's partly fair, but again, there's some luck involved because banks were certainly tempted a decade or so in the last decade to engage in the kinds of financial instruments or innovations that elsewhere were being carried out elsewhere, especially in the US. There were some banks who saw the risks and said, no thank you, even at the risk of losing some potential profits. Other banks were tempted, didn't go all the way. Now, we did have a little bit of a crisis. We had this sort of so-called asset-backed commercial paper, which is one of these funny innovations that was introduced elsewhere, but it was on a small scale. And just to illustrate sort of, although the problem, at least in dollar terms, is small, the potential for the financial system to be severely affected was not insignificant. And so the Bank of Canada there stepped in, and at the time, this was the previous governor, not the governor today, Mark Carney, but stepped in to try to resolve the issue. And the issue is still not resolved after several years. There's still some people who have suffered from the collapse of that market. So we came close. The regulatory structure helped. But if the good times that continue to roll a few more years, who knows? We may have been in the same boat as the others.
We also have misbehaved like everyone else.
It's hard to, when you have all these massive profits in front of you and others are benefiting from them, it's hard to avoid that after a while.
Now, I suppose an economist would typically say that the long-term solution to these kinds of problems is growth. That eventually, if you improve your economic performance, you can grow your way out of these troubles. Some of the other guests I have on this series, talking about other issues, for example, such as climate change, sound the warning bell about growth. We live on a finite planet with finite resources and finite energy, and we can't continually hitch our wagon to endless growth to solve our problems, because at some point we're going to bump up against limits to growth. From an economist's perspective, how do you react to that kind of concern? Does it mean that we have to fundamentally rethink our understanding of what a healthy financial system is, what healthy economies are?
Well, when it comes to the financial system, it's clear that one lesson from the crisis is that the financial system can grow to be too large. And although we don't know what the optimal size is, it's pretty clear if you look at the US or the UK case that it grew far too large, given the type of output that's produced. You're right, economists and other pundits will say we have to grow our way out of the problem. And when they say that, they tend to either underemphasize or ignore the climate change implications. That's sadly true. But growth is not the only way out. If we become more efficient, more productive, that's one way to help things along. Now, that carries with it some difficulties as well, because labor markets are shifting, are changing, and that has implications for unemployment. We haven't talked about unemployment. In some countries, unemployment is an issue. And if it remains high for too long, there are social implications. And that's going to affect growth. So growth is a necessary condition. It's not sufficient, and it's not the only thing that's going to help us out of this crisis. There are other ways, and including the fiscal side of things. There has to be a bit more sort of thinking about what the size of government ought to be. For example, what the size of revenue or expenditures as a fraction of GDP is acceptable to provide the decent social programs and so on. Mm-hmm. So there are other ways.
Mm-hmm. And in Europe, we have this interesting phenomenon of relatively open borders. So if there's huge unemployment in one area, in principle there's labor mobility, and people can vote with their feet and go try to find jobs somewhere else. Are we beginning to see that? Is there an uptick now in movement out of these distressed parts of Europe?
There is some movement, labor mobility. There's certainly more labor mobility now than there was before, say, the 1990s. But I don't think it's the same level of labor mobility as in, say, the US. It's not even close. Cultural factors seem to play a role. And there are still some members of the European Union, the UK is one, and others, that have their own regulations. They have special rules that apply to them, which limits or can encourage the amount of labor mobility. So, in principle, labor mobility would be a good thing. In practice, it doesn't appear to be a solution that even Europeans are looking forward to.
The UK has hedged its bet, hasn't it, on this whole European experiment? Not only in that way, but also by keeping its own currency.
Yes, they're really unsure. They know it's their biggest market on the one hand, so they need Europe. But on the other hand, they don't want to be restricted to a common currency unless they pass these their own tests, which are unlikely to pass. And there's also the belief that sort of maybe it's historical, that their role ought to be a bit special. And some of the Scandinavian countries feel the same way. So Sweden, for example, is unlikely to join the Eurozone because it wants that flexibility. It wants some of the benefits of the European Union, but it wants to hold back some of the flexibility to run its own macroeconomy.
Right. Well, Pierre, thanks for coming and helping me understand these complicated issues somewhat better, and I hope helping our viewers also do that.
Thank you.
And to our viewers, please join us again next week for another episode of Inside the Issues, CIGI Online Podcast. You can look for us at cgionline.org, on Facebook, on Twitter, and on YouTube.